had you asked me what's my name in my 12th standard, I wouldn't have been able to answer you because I went to a Rajasthan board Hindi medium school and did not know a single word of English. So I come from a very different world where I am today. And that's why I think my understanding of, as people call it, Bharat, is slightly better than other people because I actually come from that place. I still remember when I got my offer letter from McKinsey company, I felt that I arrived in life. I think it was a big moment. And I want to build Atomic as a talent magnet. If people get Atomic offer letter or Atomic portfolio companies offer letter, if they can feel the same high, the way I felt if we are able to attract the best talent out there, I think there are a lot of founders who are not well appreciated. They may not come from fancy school or fancy background. They may not speak eloquent English, but I feel that company building is not about presenting very well your deck. That may not necessarily come from when you went to IIM or IITs. I went to those schools, but it comes from resilience, it comes from humility.
Welcome to Unscripted, a series of conversations with emerging and established fund managers shaping India's private markets. Our guest today is Apoorv Gautam, founder of Atomic Capital. Atomic is a consumer sector focused venture capital firm that has just raised 400 crores for its first fund. Apoorv's strategy is built around a simple idea: deep engagement and concentrated bets. In this episode, he talks about growing up in Bharatpur in Rajasthan, finding his way to IIT Bombay and the Big Four of consulting, and what it really takes to build a fund that works side by side with founders. Apoorv, thank you for joining us today. Let's start with the typical Indian question. Where are you from?
My home is a very small town called Bharatpur in Rajasthan, and not of people don't know. I actually went to a government school, where teachers don't show up. So I never went to school actually in my childhood. I used to go to school only for writing exams. And had you asked me what's my name in my 12th standard, I wouldn't have been able to answer you because I went to a Rajasthan board Hindi medium school and did not know a single word of English. So I come from a very different world where I am today. And that's why I think my understanding of, as people call it, Bharat, is slightly better than other people because I actually come from that place. I was reasonably good at academics, and I thought that if I were to escape that place called Bharatpur, I had to do really well in academics. And then thankfully someone got JEE Rank 1. And I got to know there's something called IIT JEE because my photo came on third page and his photo came on first page. And I asked my parents that why this person's photo is on first page while I studied so hard. I got to know that he got JEE Rank 1, which motivated me and told me, oh, there's something called IIT JEE. So I thought, okay, let me write the exam. And I wrote JEE Hindi, came to IIT Bombay, which I think was a big transformative experience because when you come from a tier 2 town where you've not seen the real world, and when you come to IIT Bombay and among like Twitter's CEO was my classmate, ex-CEO Bharat. So I think it's a very humbling experience. You realize there are people who are more hardworking and smarter than you. And I think that was also an opportunity for me to learn other aspects beyond academics because I've been very academic oriented till then. But how do you engage socially? How do you I was involved in entrepreneurship cell in IIT Bombay. How do you take part in other activities? So it was a good experience and I learned a lot. That's been an initial days of my life.
You spent a few years in consulting with Bain, McKinsey. How did you move from consulting to early stage investing?
So I went to ISB, did MBA from ISB. And in ISB, if you do well in academics, you go to consulting. That's how it's structured. So I went to consulting, worked at McKinsey for 4 years. And then a couple of McKinsey folks started a company called Runway. And I thought it was a good opportunity for me to join. I joined them as a head of strategy, worked there for almost 1.5 years. And then I went back to Bain because I wanted to become a partner at one of the consulting firms. Bain was growing the fastest. And during COVID, I realized that what really gives me joy. Even in McKinsey and Bain, I was part of a consulting practice which was not just about fixed pay. So our fee in those projects were completely linked to the outcomes, which is what gave me a lot of joy when I saw my ideas are actually getting implemented and delivering results versus making PPTs and sort of move on. So that part of consulting excited me more. And during COVID, I was reflecting and asking what do I want to do for the rest of my life. And COVID was very unfortunate, but one thing which happened to me was it made me time to reflect. Otherwise, in consulting, you're always running, always traveling, and you don't get time to reflect. And I realized that I really find joy in building. So I had two options. I could be a founder or I could help founders in building process. I realized that intellectual problem solving gives me a lot of joy. So I thought, let me join a fund. So I joined a fund. I became a head of India investment for a US fund. And I wanted to not just be another fund manager and apply something unique to the table. And I saw one white space where a lot of investors view capital as a solution for all the problems. And they like to play a game of statistics. That let's take a large number of bets and hopefully some of them will do so well that they will compensate for losses across other bets. I did not subscribe to that philosophy, and I saw, on a contrary, founders also need help. They just don't need capital. And unfortunately, the system was set up where founders are always selling. They're always trying to portray a very rosy picture, a nice picture, while incentives are completely aligned. If you're an investor, if you're at the cap table, it's a win-win proposition. So why create a dynamic where you're just founders are always selling you? I saw a need to create a fund where you are beyond capital. And honestly, a lot of people say that. But the only question I have is how big is your portfolio? If your portfolio is of 50, 100 companies, no way you can get deeply involved. So I thought, why don't I take an approach where I can apply my consulting toolkit. In consulting, what used to happen, McKinsey and Bain take cash in consulting returns. I thought, why don't I take equity in return? So that was the model where I applied consulting toolkit, and idea was to help founders beyond capital. So I applied that playbook in my previous where I was working, and I invested in 5 companies, and each of them 10x. I was able to get exit in 2 companies, and I was able to return 4 times cash back to investors in first 4 years itself, which gave me the confidence that this playbook actually works. This was not a academic concept.
It's been a tough fundraising environment in general. You've raised 400 crores. Did you find the fundraising journey tough? And what kind of people have backed this fund?
So initial plan was honestly not to raise this kind of capital. Initial plan was to raise maybe 250 crore capital. I thought it's good enough for me to start deploying that capital. But honestly, I was positively surprised with the investor response. And if I were to reflect back, why did that happen? I think 2 things. One, I think results speak for itself. As I mentioned in the previous fund, I was able to 10x the value and 4 times DPI. I was surprised to know that their investors have not seen 4 DPI in first 4 years. So I think that very different results and such a stark difference between this and 2 other fund managers, I think helped me a lot. Second, end of the day, you need to also give confidence that why you can replicate that performance. So my playbook of not just throwing money at the problem, but really help founders beyond capital. I think that playbook, when I explained to investors, honestly, I think they loved it. And they say this is the right way to building businesses versus just giving capital, go for the best. And my view is, and thankfully or unfortunately, a lot of companies imploded. Not because there was no market opportunity, but because too much capital was given and it destroyed value, to be honest. So I think that performance plus our playbook of working with founders beyond capital resonated really well with investors. And to answer the question, who were the investors? I think, as I said, initial plan was 250, then we went to 300, 350, 400. Eventually, I had time till March 26, to be honest, to raise capital, and I think we could have gone even larger. But I thought, let me just pause it, and we sort of conclude the fund in August 25, and we did first close in August 24. So within 1 year, we closed the fund at 418 crore. out of 418 crore, roughly 100 crore has come from two institutions. Roughly 100 crore I will say has come from family offices, and 200 odd crore has come from HNIs and individuals.
Your model is deep engagement, concentrated bets, which means fewer companies in the portfolio. What does that translate into in terms of ticket size?
So first of all, because of our operating VC playbook, we spend significant time and effort with portfolio companies and the founders. We can't do this with large number of companies. So we have some sort of constraint to not invest beyond 12 to 15 companies. While other funds take a large number of positions, we will take fewer positions. So that's point number one. So when you're deploying 400 crore capital across 12-15 companies, then the kind of check you can write is 20 to 50 crore check. Initially, the fund size was expected to be smaller, hence you're writing 10 crore check, 12 crore check. But the idea is do 20 to 30 crore check as a first time check. And secondly, then we can also put some capital to follow on this. So that's the idea. In terms of playbook, I think there are multiple aspects of the playbook. One thing which I would like to share is no two human beings are same. Similarly, no two companies are same. So we don't want to copy paste the playbook. What worked in one company exactly may not work in another company. So we try to contextualize the playbook. And how do we contextualize? For you to contextualize the playbook, you have to understand the context. How do we understand the context? We spend significant time upfront with founders in a very listening mode. What is founders' motivation? What is the product? Who is the TG? Because there are multiple ways of building companies in the same category itself. So rather than saying, oh, this work there, you can apply there, which is what people do when they sit in only board meetings. When you sit in quarterly board meetings, you are just trying to apply patterns when they may not exist. In our case, I speak to every founder in a portfolio company every single week for an hour. And that 1 hour conversation is not let's chit chat and how you're feeling and how I'm feeling. We do that as well. But it's a very structured conversation where 3 to 4 days in advance, we align on a set of topics we will deep dive. And we actually go deeper into topic by topic. So that structured, regular, weekly cadence helps us stay close to what founders are trying to build and understand the context of the company. So that our growth levers are contextualized for the company's journey versus copy paste from other company. That's point number one. Point number two, I say this a lot to my founders. I don't understand Hindi. I don't understand English. I understand only maths. Because I think what happens, founders are drinking their own Kool-Aid, we drink our own Kool-Aid, but I feel Excel sheet doesn't matter. So we spend significant time and effort in validating our belief with very weak data signal. Not everything can be explained by data. So we have a hypothesis, but we test it in a small way, and then we see signal. I think the skill we bring to the table is how are we able to differentiate very weak signal in the noise. There's not a clear signal, but it's a clear signal, anyone can see it. Our ability to see what is working when no one else can see what is working is what I think gives us the edge. So our ability to work with founders to make that discussion very objective. Because invariably when you work with founders, there are differences of opinion. And we trust founders' judgment, but we say, okay, you know what, let's just do what you are suggesting, but let's have a guardrails in terms of maths. And when we look at every decision in a very objective manner and our ability to bring maths to the conversation of English or Hindi, I think that differentiates us. And third, I think we have a point of view and perspective. We don't just go to the room and say, tell me what you're doing and try to learn from one founder and each other founder. We form our own view, which we very openly and transparently discuss with founder, and founders really appreciate that. Because what happens is, I give this example. If you go to Juhu Beach, it stings for first 5 minutes, then you get used to it. So what happens is when you're living a certain life day to day, you don't see what is not working. Our ability to have an outside view, our ability to, we speak to 30 to 40 founders every week, and we learn what is working in the market, and we bring those learnings back to the founders. So we have a point of view which may not be right, but founders appreciate your point of view, and we discuss in a very objective manner, and we share that point of view with founders. And fourth is our ability to be true partners. True partners do not mean praise you when you are successful and criticize you when you are not successful. We see our role as a coach. I give this example that Virat Kohli's coach batting is no way closer to Virat Kohli, but still he has a coach. So we tend to play that role that how can we improve the company's performance When they are doing well and found everything is working, we look at for risks, that what risk company has. And when things are not working, founders are disheartened. How can we motivate them, energize them?
So, if you're investing in fewer companies, how do you build the thesis for each of those bets?
I think one thing people do is, in my view, context is everything. Let me explain what do I mean by that. The way my playbook works is very different from any other fund. So the companies which are attractive for them may not be attractive for me and vice versa. And let me explain. I keep telling my team is, our job is not necessarily to make right decisions. Our job is to make our decisions right. So because we are building companies with founders, we are not looking for the hottest sector or hottest founder. Obviously, we'd love to work with them, but I've seen that I think there are a lot of founders who are not well appreciated. They may not come from fancy school or fancy background. They may not speak eloquent English, but I feel that company building is not about presenting very well your deck. That may not necessarily come from when you went to IIM or IIT. I went to those schools, but it comes from resilience, it comes from humility. So the point I'm trying to make is, our lens towards evaluating investment opportunity is very different from the lens other investors take. And this is not right or wrong, it's just a different way of approaching the business. Point number 2, we look at, first and foremost, our ability to collaborate with founders. I call it a professional marriage. Because these are long-term commitments, incentives are completely aligned. And third, end of the day, you also want to enjoy the journey. Obviously, outcomes are important, but because we spend so much time, I do not want the person to hate me or me to hate them and talk every week. We want to make sure we are partnering with the right founders. So founders play a very, very important role. Founders who are willing to look at data and change opinion. I call it strong views, loosely held. So I think those kind of founders, humble founders who are true partners in the journey and who appreciate partnership. I think the kind of founders we look at, and that is 80% of the answer, to be honest. And second, I think we have a point of view on certain sectors. As I shared, our job is, what will India's consumption look like in 2030? And work backwards to say what opportunities we need to back today so that we look good in 2050. I think that's the business we are in. And there are multiple trends, whether you talk about premiumization, whether GDP per capita goes up, certain categories and mega trends will emerge. Whether it's about wellness, whether it's about looking good, whether it's about consumer enablers. So we have a point of view, what will the India's consumption be in 2030, but at overall level, by category, by geography, by different cards. And we sort of work backwards to say today, what can we invest in so that it sort of becomes a business opportunity.
Can you share an example of a portfolio company where the atomic model has kind of played out the way you expect?
So I think these are early days, but again, if I were to pick one example, I'll pick a company called Chemist. There was the first portfolio company of Atomic Capital, but the reason I invested in Atomic Capital, I think the story goes 2 years back. So Robin and Prakhar had been pitching me for last 2 years. So first time they pitched me and their economics were horrible. I told Robin and Prakhar, I'll never invest in this kind of numbers. What I was surprised by, they took that feedback and came back again and pitched me. That time I had a challenge with one of the way they are approaching products. I said, Robin Prakhar, I don't like the way you are thinking about building a business. They actually incorporated their feedback and came to me. I was first of all very impressed. As I said, founders are the 80-90% of our answer. I was very pleasantly surprised with honesty and sincerity they showed towards my inputs. And they kept reaching out to me for help and advice, which gave me the confidence that these are the kind of founders who want to partner with. So eventually when they came fixing the economics, fixing the products, I was like, we would love to partner as an interesting category. So now if I were to give you some numbers, they were doing, I think 15 to 20 crore live revenue when we invested with them in September 2024. Now they're almost doing 100 crore in a year's time. So they've grown 6 to 7x, maybe more, in a very capital efficient manner. We gave them 9 crore primary capital. Large part of it is unutilized. While a lot of companies are just chasing who is going to give me next capital. A lot of funds say, oh, markup. I don't care about markup. I think we want to build capital efficient businesses, so they've not even utilized large part of capital. They've grown significantly. That can only happen when you grow both top line and bottom line. They've become more profitable and they've grown top line significantly, which is what is the constant theme across my portfolio companies. I feel that when you just look at top line and don't look at bottom line, then you're buying growth, which is not sustainable. And in consumer business especially, I think technology businesses require very different playbook. But in consumer businesses, just by buying growth doesn't make it sustainable. And you can solve for profitability and capital efficiency from day one. It doesn't have to be solved only at scale like technology will. A lot of times people confuse consumer business with technology businesses where they feel, oh, profitability can only come at scale. I think consumer businesses can be profitable at any scale. It's a choice. So in case of Chemist, they are more profitable. Their top line has grown significantly. Second is about consumer love. I think end of the day, and that there is no one way to measure that, but retention is one point, NPS is another one. So we institutionalize certain best practices in measuring in a very objective manner. Otherwise, what happens? Founders say, "I spoke to farm customers; they're very happy." But that doesn't mean that everyone is happy. So our ability to put together processes to objectively evaluate consumer love, what is working, what is not working. Third, I think, which is the most critical aspect, is quality. Founders I've seen are always in hustling mode. They're trying to always solve the problems of today. While I believe all building has to be done proactive manner. The reason is, if you give an offer letter to someone, the person has to serve notice period 1 to 2 months. The person joins, starts adding value, takes 4 to 5 months. So one of the conversations we have with all our founders is, for example, we're sitting in October 25. One of the conversations I'm having is, in April 26, what organization will you need? And let's start building it today, because that takes time. So our ability to work with founders on building the right organization in a very proactive manner. So I try to make sure that organization doesn't become a bottleneck in companies' growth journey.
So within the broad consumption space, what kind of sectors, themes, businesses do you like?
I am chasing incremental consumption. So there are categories which are big but not small. I will not invest in this category. I mean, relatively they are not as attractive because incremental consumption. So the intellectual framework I use is from today to 2030. If I look at incremental consumption, which categories will have the largest impact? And third, I think it becomes I feel that digital businesses, digital brands have a better return on invested capital, OC. So I like to start with businesses which are digital first. And there is a fundamental way digital businesses get built. Typically, you acquire customers through Meta, Google, some of the digital platforms, and you have to pay a fee. So you have to maximize the ROI from each customer. And for you to do that, you need to drive higher retention. So I like to back businesses in categories where inherently there is a higher retention. Because I'm backing digital businesses, and there is a little bit of bias in us to value businesses more when they own customer relationships. The businesses which directly sell businesses, it could be offline, it could be online, but when you own customer, I value that a little bit more than when you go through it directly, through marketplaces. So these are some of the principles we follow. If I apply that lens, there are certain categories which automatically emerges. For example, beauty and personal care, digital first, good economics. If you're able to convince someone to have a beauty and personal care, if you like a particular serum, it works for you, you will not change that. So retention is very high. So I think beauty, and people say, oh, this is such a cluttered market. It's fine, but still incremental, new people, new consumption who are looking for new beauty and personal care brands. So I think we like the category a lot. Second, I think wellness is a very important thing. Wellness is multiple aspects. You have physical wellness, for example, people who are looking at, so we have a company called Fitello, which has done well for us. So I think some of those wellness aspects, and wellness as a mental wellness, spiritual wellness, there are a lot of aspects of wellness. Whether you talk about weight loss, whether you talk about specific breathings, etc. So that I think becomes a very interesting category for us. Third, I think people also being conscious what they consume in terms of food and beverage. I think it's a massive opportunity. People are reading labels. People are becoming more aware. There's a large opportunity, proteinification. There's a mega trend. Protein wave has come up. Weight loss is another food and beverage mega trend. So our ability to identify these mega trends and back food and beverage brands I think another category which is interestingly emerging is pet care. One could say it's such a small market, going back to our earlier conversation. But if I take a 2030 view, I think it's a massive incremental consumption opportunity. And pet care also has multiple aspects: food, products, services. So pet care is interesting. And then there are other products and services market which are like, for example, jewelry as a space, and it is also evolving. So my view is, I think one fundamental consumption story in our track is Middle India. We feel that the top India, which honestly physically stays in India but mentally they are in Europe or US. They like to consume very expensive brands. Then there are low bottom India, which I think is large number but consumption driver is not that much. Middle India is what we are looking for: aspirational Indians who are value conscious, who are looking for new brands who are able to provide them value. So we are actually chasing them these categories.
In a year from now, what would success mean for you?
Yeah, I think I see that as a consultant, it's very easy to put things on a slide, and it's very easy to say things on a podcast or give gyan. But actually to make that happen is not easy. I think whatever I'm saying, if I'm able to make it happen, I'll be very happy. If I were to be very technical about it, I think if Atomic becomes the most preferred consumer fund in all the founders, I think that's what I'm looking for. I think if every founders feels that we want to work with Atomic, I think that is very close to my heart. I think when in some cases when we work with founders and our ideas work, or we get to some insight which unlock, which was not visible earlier, it gives me a lot of joy. So if we are able to create that positioning, that if you need not just capital but a true partner beyond capital, to Atomic Capital, if we are able to establish that, that will give me a lot of joy. Second, I think I still remember when I got my offer letter from McKinsey company, I felt that I've arrived in life. It was a big moment, and I want to build Atomic as a talent magnet. If people get Atomic offer letter or Atomic portfolio companies offer letter, if they can feel the same high, the way I felt if we are able to attract the best talent out there. And last but not the least, as I said earlier, there is no dearth of capital. If we can, the people who have backed us, I think it's been very humbling experience, the fundraise part. The investors, we have 138 investors who have backed us. I think if they feel that they made the right decision, and if I can make them feel that their capital is in right hands, given that I'm a first-time fund manager, and I feel that capital is a big responsibility. So I want to make sure that I fulfill the responsibility in the right manner. From 1 year from now, I think if I'm able to demonstrate visible wins to my investors, the third point, I think if these three things happens, I'll be very happy with it.